The live session getting transmitted from Chennai from my office, and this is Ranjan. And today's session's objective is to learn specific option strategy for consistent gain. So before I will go to the session, little bit of discussion on the trend part we'll have. So what we have given last week and what trend it has happened. Every week you are getting the option strategy as well as the Nifty and Bank Nifty trend reports. So Nifty and Bank Nifty trend reports you are getting. So what we have said and how far it has succeeded. These are small announcements, and we will be starting the session exactly at 7:30. So if you would have downloaded the report, this is the report we have produced for the week 30th April to 4th May. Today is the last day for the week. So what you have got, if you can see today's price 10,640 was the day's low of Nifty. Just it missed the 3 points from our second target, calculated target, second target. It has just missed the 3 point from there. If I go back to the Bank Nifty, how it has performed, and this is the Bank Nifty's level. And if you can just go for the Bank Nifty today's day's high was 25,000. It was 25,738 as per the NSE data, and the calculated one, if you can see, calculated one was 25,732 was your second target. So this is what you have achieved. 737 achieved, 732 was the calculated one. So many weeks we have demonstrated this kind of success, and every week we release the trend report. This week's report also is being released. You can download the report from this particular download link, download market report, and many Android apps we have developed, free apps. This is an app to learn many concepts. So you can download this app and start learning some of the future and option hedging techniques, stock selection techniques, technical studies and all. Besides that, some of the free apps wherein you can punch some data and get some outcome. You can say here intraday options, dynamic Fibonacci, intraday trend analysis, pivot, Elliott, Camarilla, midpoint calculator, Gann square of 9 and square of 12 outcomes. So these are the free apps in our domain. You can download it, use it. There is no restrictions. You can distribute to your friends also. But it has a limited success, and paid app will be having somewhat higher success. That is the difference. So coming week, what we are expecting, though I will be starting the session exactly at 7:30, I told you. So coming weeks, what is our expectation? So this is the trend report you can able to download 7th to 11th May. If Nifty move above 10,693, it will be uptrend. Below 10,627, it will be downtrend. And if it consolidates, means 731 to 10,731 to 10,589 will be a consolidation zone. All these things, whatever I am saying, it is as per the Fibonacci principle. And how you can trade above 10,693? Always I used to say you must hedge. If you are buying it, you must hedge it with the 10,700 put option. At that particular time, you will be getting the put option at 110 to 120. I have also given a table here to demonstrate, even though if you hedge, how will be your profit and loss will be projected. If you hedge it with 120 put option, buy the future and future move to different levels, what will be the net profit you can get? If it triggers the stop loss, how much you will be losing. So here too also I have given the similar kind of studies in downtrend how to work on that. Similar logic you can follow for the Bank Nifty. Bank Nifty also I have given the levels. But here one small changes you have to follow. Bank Nifty all entries should be above 0.38 because its base is very high, 25,000 is the base. So for that reason only you have to take it. Follow this report, forward it to your friends so that they also will get a chance to know some of the rational techniques. So today's session, as I told to you, it will be on how to form option strategy for the consistent gain, and this particular event will be starting exactly at 7:30. 2 more minutes are there. So 2 more minutes are there. So I'll be waiting for that time. Then I will be starting. Smart Finance has a broad range of educational product and your softwares. If you are an intraday trader, particularly if you trade on intraday more, then you can go with this one standard deviation software. So this weekly report also is being generated using the same software. It has an Android app as well as desktop. It costs you 5,900 including GST. Option strategy, if you want to trade, this is a software we have. So various option strategies combination you can form. GAN angle and volatility, we have a software. We have a GAN software which has GAN square of 9 and square of 12. And all these individual softwares is clubbed into one platform. So here too also you get an Android app. This costs you 8,500 plus tax. So 10,140 it costs. And all these courses based on different objective it is designed. All courses will be 2,000 plus some postage charges will be there. And if you buy all together, so here all softwares and all courses, you get a hefty discount. So it costs you 17,500 plus 990 as a tax. So this is about our product. But before choosing our product, it is my sincere appeal. Test the weekly report for 1 or 2 weeks. View some of our free calculators, read some of the articles. So by this process itself, you can able to identify what is the method. Then you can go with the softwares. Topics outlines are as I have given here. What is the option strategy? Best option strategy for consistent gain. So what are the strategies we can form, combinations we can form so that it should give us consistent gain? How to form that? That is very important. How to form an adjustment? So on adjustment, though it is a very vast subject, that option strategy adjustment, I will just break it to very simple concepts or very simpler way I will explain you. Then if you understand this particular concept, you yourself can find out the way and how to set a goal. So every business, every profession you do, you set a goal, you set an objective. So all these things also applicable in your option strategic trading. So all these things we are going to learn today. So coming to my first part, very first part, there are two definitions you will find out. So it is a risk neutral way of trading in stock market. Why we do the option trading, option strategy trading? It is a risk neutral way of doing the trading. So market always having a risk to go up, risk to fall down. So for a seller, if it goes up, it makes loss or create loss for him. For a buyer, if the market falls, it creates loss for him. So this kind of situation where nobody knows that whether the market will go up or come down, whatever the study you do, whatever the analysis you do, predicting the future is an impossible game. Predicting the future. You can have a probability of assumption, but completely to say that I can predict the future, I can say you tomorrow what is going to happen in the market. It is not possible. We can just calculate the trend. Based on the trend breakout, we can take a call. All technical studies said that. If you say moving average, oscillator, indicators, or GAN study, everybody says that you can calculate the trend. If the trend gives you one breakout, you can go for that. So there, this option strategy helps you to form a risk neutral way of trading. And there is another one definition which you can find out in the Wikipedia. It says that simultaneously buying or selling one or more option that differs in their variable terms, or that differ in one or more option variable, means two different strikes you can choose. You can buy, sell, whatever you can do. When you do the same instrument, you take a neutral view. That time it is known as option strategy. I have given a small example. Say Maruti is at 8,720 or 30, whatever may be. If I buy a call option at 195 and buy a put option at 155, so this is form a strategy. So the name of the strategy, you will be knowing that long straddle, short straddle, long strangle, short strangle. So many names are there. So this also will have a name. So forget about the name. If you enter this kind of trade, buying a call option and put option of this particular premium, then it's break-even points. So if, because you have paid this much of premiums, so this will be your maximum loss. This 195 and 155 will be your maximum loss. So you have chosen the same strike. So if in upward direction Maruti move above 9050 or at 9050, you will be at break even, no profit, no loss. Above that you will be making unlimited profit. If it goes to 10,000, 10,500, your profit is more. Same way, till 8,350 in the downside, you are at a break even. Below that, you will be making profit. So, the point what I want to explain you here, by this process, you are deriving a risk neutral. If Maruti goes above 9,050, I will be making profit. If Maruti fall below 8,350, I will be making profit. Between this zone, I am not going to make any profit. So this is what you have. This is how you made your risk neutral. If it doesn't move above 9050 or doesn't fall below 8350, I am ready to lose this 195 plus 155, this much of money. So this is your objective of your strategy you formed, you initiated. Or by definition, this is the option strategy. Many used to say, what is option strategy? So this is the meaning of option strategy. Then how to set a goal? So before I initiate a trade, I must set a goal. Why I am initiating this trade? What is the objective of this trade? What is the need of this trade? And what is the parameter which has helped me to take that particular call? So while forming this option strategy, you must have a goal in place. So here, many ways you can put it. However, to me, the most important factor to set your goal is the volatility condition. At that particular time, what kind of volatility condition is there in that particular instrument? Say if I say that if the annual volatility of that particular same Maruti example is 40%. So it is known as the high volatility script. Many of you would have attended my earlier programs where I have told any volatility above 40% is high volatility and below 20% it is low volatility. Between this zone, if you go for it, is a medium volatility situation. So I never speak about a term wherein I say that high volatile market, but I won't give you figure. How I will identify a high volatile market? If it is annual terms, if the volatility is above 40%, it is high. Annual terms, if its volatility is less than 20%, it is low. Between this, it is medium volatility. If annual volatility is above 40%, it is high. So in this situation, what happened? So the time value of the options will be more. The option premium will be having two parts, one time value and one intrinsic value. So any instrument having a higher volatility, its options will have the higher time value. So in this particular situation, my goal will be to earn from the time value decay. So if it is a low volatility, so what I should, so low volatility when it is being projected, when the prices will go up, the volatility will fall down. So price and volatility is having a adverse relationship. Price going up, volatility will fall. Price falling, volatility will go up. So when it is a low volatility condition, that time the prices is going up. So I will aim to earn from the intrinsic value. So to earn from intrinsic value, different strategies I will form. So here it is a high volatility situation. My goal is to earn from the time value. So I have formed a strategy. I got my goal. I am going to form the strategy. So in this particular strategy, once I am going to earn from the time value decay, so I will be a majority seller in the market, and my sell trade I have to protect. This is what this become a very simple thing. So I will be selling a call option and put option of same strike. You can form any combination. Just for the sake of example, I am giving you this one. So you have formed a call option and put option. You have sold each one lot. You received this 197 and 175 as a premium. And since 200 rupees you are receiving here, almost 200 rupees. So just 200 point above that 8,900 one call option you are buying. And here too also very near to 200 rupees you are getting. So 200 point below itself you are buying a put option. So this is what you did. First you have identified what is the volatility condition. You set a goal, and to meet your goal you have taken some objective steps or form a option strategy. So once you form this option strategy, you must know in which kind of scenario it will give me the profit and when I should come out. It should not be a one-way game that I should enter to a tunnel and I should not know that how I will come out of the tunnel. You must know beforehand itself why I am going to enter to the tunnel, what forced me to enter to the tunnel, and how I will come out of the tunnel. So that is what your analysis says. So now your analytic part says you have a median point. So you can say 700, 900. The mid of that is 8,800. Mid of the downside is 8,600. So if Maruti price moves between the median points for your period of holding, suppose you have found this particular strategy, you are going to hold for 10 days. Within this 10 days, Maruti move between 8,800 to 8,600. So every one day past, theta will be decaying, vega will be decaying, you will be making some profit from the volatility decay and time value decay. Any point during your holding, if the stock move beyond the median boundary, what is your median boundary? 8,900 where you have hedged, 8,500 where you have hedged. So this median boundary, once your price moves, then you have to quit it and come out. That time it will be a very small loss will be there. Because one wing will be giving you profit, another wing will be giving you loss. So one profit and loss will be offsetting each other and you will be getting a very small loss and you have to come out. And profit and loss you can analyze using our option strategy software, or you can analyze using any of your software, or you can do some theoretical analysis on that. So whatever the profit and loss payoff, everything you have to analyze with the help of a tool. But this will be your basic objective, and this is how you set a goal, this is how you should enter, and this is how you should exit. So three things you got. You set a goal, you enter a trade. Before you enter a trade, you are fixing a term to exit the trade if the trade goes against you. So this part This is how you should set a goal in your option strategy. So this part things I have given. If you have my book on the master's key to futures and option, so this book look like the master's key to futures and option book. This particular book, if you have the last part I have analyzed, or I have given these particular steps how you can analyze one option trade. So the same thing in scratch I have just defined that. So coming to the best option strategy for consistent gain, as I told you, what is a consistent gain strategy? If I initiate this particular strategy, the strategy should give me small gains but consistently, month on month basis, year on year basis, I should test. And in options, many combinations you can form. Many combinations you can form. But I have found out there are two combinations which gives a fantastic return, though it will be small, sometime it will be big, sometime it will be small. In most of the market condition, one is the cross calendar short ratio spread. It should be in the call and put combination, both you have to take. For that one, trend analysis also you have to do. Second is short straddle with long straddle, what already I have shown you. Current month at equal distance. This one I have also already exhibited. Why these two strategies used to give the profit in all conditions, all consistent gain. Whether it is small gain, what gain will be there. These strategies, why it gives the things, the volatility, whatever may be, the theta, the time value decay is a definite. So time value of any option has to die down till the expiry. Only thing is that loophole in these particular two strategies. If the intrinsic value goes on built up, then you may lose something, but for that you can derive a plan also. So in this particular cross calendar spread, what we are doing, if you are just looking at the analysis, this is one standard deviation analysis I am doing for the 10 days period for Nifty. So these are the levels I got. Once I got for 10 days period. So once I got these levels, I have now Nifty is at 10,660 coming 3 days period. These are the levels I am getting. Third cycle uptrend and third cycle downtrend. So third cycle uptrend 11,200, here 11,127. Slightly I can go for the nearest. Do not go to the boundary. Little bit you can just backtrack yourself. You choose the strikes. If it is going to 11,200, you choose the strikes 11,100. If it goes to 10,127, choose the strike of 10,200. What I'm going to do here, this current month, this is month of May, I'm buying one call option and put option of the current month, and I'm selling the out of money options to two lots each from the for the month of June, 11,100 call and 10,200 put. By this process, what happened? I received 40 rupees premium here. I spent 142. I received 130 premium here. I paid 135 here. So if there is a gradual up move or there is a gradual down move for a period of 5 or 10 days period, and because market will never be consistent at here, if it still remain at 10,660 for coming 10 days period, you may not be making any profit. If there is a 200 to 250 points of move happen, or in more technical terms, if the price move to second cycle of uptrend or second cycle of downtrend, you make profit in this strategy. Though it will be small, but it will be definite. You need to look into your brokerage and taxes part. If your broker takes a great brokerage, you may not make profit. If you are with any discount broking, then you may get some good profit. Coming to the second strategy, which I used to say A definite strategy which I have already shown you. Short straddle with long strangle in current month at equal distance. Short straddle means the same strike, call and put you are selling. And always you will find a high volatility stock in the market which will be having above 40%. And equal distance, whatever the premium you have received, 200 you received, you are choosing the next 8900 strike. Here you are getting 1175, you are just choosing the boundary as 8500. So if you form this kind of strategy also, and if the price move in the median point, you make a decent gain. And this is very useful if you can initiate in the weekly option of the Bank Nifty. Bank Nifty weekly options, if you can initiate, it will be highly useful. You can get a very good earning from this also. So this is also a consistent gain strategy. I have already explained when to, at what condition you make a profit and what condition you have to exit out of this thing with a small loss. If it crosses your median boundary point, come out. As long as it moves in the median point, you are making a profit and hold to that strategy. So this is a second strategy. Many other combinations also there. You can form conversion strategy. You can form many other strategies we can gain you from this, from time value. So when you target the time value of an option to convert to your profit point, that time you can say that you are aiming from a consistent gain. Any strategy, any option combination, if it is aimed towards a time value decay gain, then it is known as a consistent gain strategy. Any combination you can form. Then coming to the next part, how we can form this kind of strategy. Look at volatility and set your goal. And little bit you have to form this put call ratio analysis. So put call ratio analysis will give you a trend direction. So trend analysis you need to do to understand the price actions and any pre or post adjustment. So these are the 4 steps you have to do. So trend analysis part, you have seen how for Nifty we have chosen that things, how we have set the goal, you have also seen that. Put call ratio analysis, as I used to say, though every stock's put call ratio analysis will not be a clear indicator for your trader, though every stock's put call ratio analysis is not a clear indicator. However, Nifty PCR, always I used to say, if you are a old participant of mine or if you have already attended any of my program, Nifty PCR will give you a great information about the trend. The moment the Nifty PCR will cross above 1.16 and maintain above 1.16, your trend will be up. The moment the Nifty PCR will fall below 1.05 till 0.95, this will be trend will be range bound. Moment it fall below 0.85 for Nifty alone, do remember this, it will be a bearish trend, downward trend. So this indicators is very important indicators and it's a fabulous indicator. Any time you can test it for any number of months and you give your feedback. So how to find out this PCR of put call ratio of this thing Nifty? Just go to the option chain of the Nifty. NSE is giving you that. And once you go to the option chain of this particular Nifty, the current month's Nifty, just go down here, you will find out number of put contracts, number of call contracts. These two things you divide. So whatever 3.7 crores divided by 3.2 crores, you will get the PCR. And PCR also having other meanings. When the PCRs are falling, put call ratio are falling, PCR is falling, that also indicates an intermediate downtrend. When the PCRs are increasing, this also indicates an intermediate uptrend. But the news channels, the news parameters will give you a contrasting view. Just opposite thing they will tell. So you will be saying that okay, they have told these things, but we are getting opposite. Actual fact is whenever PCR goes up, that means your long trades are being hedged at a lower put price, or it is being further hedged to protect the profitability. So this will again fuel the rally. When the PCRs will be falling, intermediate downtrend will start. However, once this Nifty PCR will fall below 0.95, you will be getting a very good downtrend. Same way 1.16 above, you will get a good uptrend. However, in new settlement cycle, need to wait for a day or two to decide the PCR. Thursday market expiry happens for the previous. New settlement cycle starts from Friday, but you take a PCR analysis after Monday. That will be a great choice. And individual strikes PCR also gives you a great thought. So individual strikes, suppose 10,500 strike call and put there PCR, you can take from there also, you can derive some views. So this is a very great subject. Now trend analysis to understand the price actions, that already I have demonstrated here. Here this kind of studies, whenever we take for some weekly study for the Nifty, this is the report you will be getting. As I told in the very beginning part of my lecture, this is the thing you will get. This first cycle only is being given in the report, second, third cycle is only available in the software. So these particular values what are being given. So this says that one trend, and Fibonacci, if you are learning, you will be knowing that this is the trend reversal zone or the most important resistance point. This is the most important support point or trend reversal zone. So that's why it is being colored as per the Fibonacci principle. So Fibonacci is also a great subject, but it is out of the scope for today's discussion. So today coming to the last part of my analysis, which is the adjustment. What kind of adjustment I will do? What is the adjustment? So when we do the adjustment, option strategy adjustment, this itself is a very great subject, very big subject, and it requires a lot of skills also. These adjustment techniques. When I talk about adjustment, it has only one objective. I have initiated option strategy. It has two probabilities. Either the strategy can give me success or the strategy can give me failure. So once I failed in the strategy, then I am just doing some plannings. I am just adding some new components in this failure point so that I can recover my losses. Whatever losses I have incurred, I can recover back. So the plan may be to keep a constant delta, plan may be to keep the constant vega, whatever may be. If strategy gives me success, no issues. If the strategy gives me a failure, then there is a point to worry. I am doing some new plannings, new components I am adding to the strategy to recover back my losses. That is called your adjustment. This adjustment can happen in two ways. One is pre-adjustment, another is the post-adjustment. Post you get a failure, you adjust. That is one. Pre-adjustment, before you get a failure, you make adjustment. But it should be at a lower cost and some margin you have to pay. Suppose I am just going for this particular analysis of Nifty, what I have shown you. I sold a call option. I bought a call option and put option, and I sold this 10,100 call option, 10,200 put option. What is the risk in this particular strategy? Though it is a consistent gain strategy, what is the risk in this strategy? Once the price suddenly move above this 11,100, I will be making a loss. So if 11,000, here I got some 39 points of premium, my losses will be starting from 11,139. Above that, my losses will start accumulating. Same way, 65 I have sold here. If it is going below 10,135 below, I have an unlimited loss because two times I sold, one times I bought. So this is the situation what I should do. If I am going for a pre-adjustment, then I have to look into the PCR. PCR is telling me 1.35. So 1.35 means it is an uptrend I have a uptrend risk. If PCR is 0.85, then I have a downtrend risk. So while initiating this strategy, I have just introspected the PCR. It said that yes, your strategy having a higher probability of uptrend risk. So I am doing a pre-adjustment. What I am doing here, I am just 11,100 call option. I am just selling. I have already sold 2 lots. One more lot I am selling for the next month. And same strike 11,100 call option. 3 lots I am buying for the current month at a very, it is deep out of money. I am just buying at 10 rupees. So though this process also given me some 9 rupees credit, but when it will move or come to that level, if uptrend risk comes true, at least at the point of exiting this strategy, I will not be having a loss. I will be making some good profit also. This is called pre-adjustment. If the PCR could have been lower, I would have done in the put side some pre-adjustment. Coming to the post adjustment. Once this post adjustment say that if strategy goes against you, then you have to initiate, or else you do not have to initiate. Suppose it has come to 11,100 or it has come to 10,200. At that particular time, the similar kind of action you are initiating. You are buying 11,100 call option current month and selling 11,100 call option next month. So you can do this one in the post adjustment, or you can book a loss and come out also. So these are the very basic principles of adjustment. So whenever we form a covered call whenever we form means one future we are buying and one call option we are selling. We expect that future will go up, call option will decay, the time value will make money. For when we make this future buy with call option selling covered call, so there 2/1 ratio put spread is a adjustment. So 2/1 ratio put spread is a adjustment, or you can take 5/2 ratio put spread as a adjustment. So based on your every strategy, the counter one is your adjustment. So this is what the adjustment is there. Most simplest term, but it has a bigger definition also. It has a bigger technical wording also. When you neutralize with delta, vega, theta, all option parameters or option Greeks, that time you have to form a adjustment based on that Greek by adding some lots, subtracting some lots, that you have to make it more complex. So this is the concept of adjustment. So more detail about the option courses you can find out in my book on futures and option. We also have a fantastic course for the futures and options which cost you 2000 plus some postage charges. This also having a 14 to 16 hours of option strategy course available both in English and Hindi. So this particular course content you can see here. It is 14 hours DVD course. So all these contents are sitting here. All these contents you can learn. So if you are interested, you can opt for this course, and any product related queries you can call to this number. Our sales people will assist you. Whatever is written here present in the course. So you test it, you see some of our videos. That's why in the beginning part of the lecture I told, do not buy any of our product without experiencing us. Go through the video courses, download some of our apps, and we have a great learning app also we have given. You can learn, install this app and try to learn some of our concept. After experiencing us, then you buy. Do not think that I'll buy, then after what happens, I do not know what is there. We never sell such kind of product, JVRG. Whenever we are going for our option tool, someone is asking me how I can get the real-time basis that Greek calculations. So if you are a user of our software, you choose any of the strike. You can choose any of the strike. I am choosing call option calculate. You get all the calculations along with its delta and other things. So it is real time. It will change. have taken the recording of this particular event. It will be soon live on our YouTube channel. If you are visiting our YouTube channel or if you have subscribed to our YouTube channel, you will be getting the intimation. So if you have not subscribed, please do subscribe to this channel. If you have already subscribed, you will get the intimation. We will be soon uploading this video. Maybe by tomorrow morning, you will get this video. View this live sessions recording, and in case of any query, you feel free to put me the inquiries. Here we have given the inquiries. You can send an inquiry with your queries. I'll be glad to answer your queries. Thank you very much. Good night to all of you.